So be there. That is the question which we were supposed to start from, where we left in the last class. So allow me to read the question. It says, River Limited operates in a fast-moving goods subsector. During the year ended 31st March 2023, River Limited expanded its operations by acquiring a controlling interest in Sai Limited and a significant influence over the activities of Tutu Limited. The following draft financial statement for the year ended 31st March 2023 relates to the three companies. So River Limited, Sai Limited, and Tutu Limited. So we have been given their profit account for the year ended 31st March 2023. Also, we have been given their statement of financial position as of 31st March 2023, as your eyes can see there. Additional information number one, let's go to the additional information number one. On 1st of July 2023, River Limited acquired an 80% ordinary shareholding in Sai Limited for a cash consideration of shillings 1,100 million. The fair value of assets and liabilities of Sai Limited were equal to their carrying amounts at the date of acquisition. So that is revaluation. They are saying, just a minute. So on 1st July 2022, River Limited acquired 80% shareholdings in Sai for cash consideration of 11. So 11 is the purchase consideration, where they are saying the fair value of assets and liabilities of Sai were equal to their carrying amounts at the date of acquisition, meaning there was no revaluation. When the book value, carrying amount is the book value. When the book value is equivalent to the fair value, it means there is no revaluation in the books. Fine. The group's policy is to measure the non-controlling interest at their proportionate share of net assets of subsidiary at the date of acquisition, meaning we are going to use the full method. On 1st January 2023, River Limited acquired a 40% ordinary shareholdings in Tutu Limited for a cash consideration of shillings 500 million. So 40% means Tutu is an associate. So associates, we don't consolidate for them. We only consolidate for subsidiaries. During the post-acquisition, River Limited sold goods to Sai for 300 million. River Limited reported a 20% profit margin on this sale. Half of the goods remained in the ending inventory of Sai Limited at the year end of 31st March 2023. That one will help us to calculate the unrealized profit on inventory. On 1st of October, note number 5, included in the trade receivables of River Limited was 80 million due from Sai Limited. In the books of Sai Limited, the amount due to River was shown as 60 million because Sai Limited had remitted 20 million, but River Limited had not recorded the remittance. So the 20 million is cash in transit. You see the intergroup balance was 80, but the other side is claiming 60, meaning the 20 is the cash in transit. Good. Number 6, on 1st October 2022, River Limited sold an item of plant to Sai Limited for 400 million, reporting a 25% profit margin on the selling price. and netted off the profit against its cost of sales. So when you sell an item of plant at a profit, that is called UPFA, unrealized profit on fixed assets. So we shall check later. The group charges depreciation on the plant at the rate of 20% on cost on full year basis in the year of assets purchased and none in the year of disposal. Impairment test carried out on 31st March 2023 revealed that neither the goodwill on acquisition nor the investment in associate had been impaired during the year. None of the group companies paid dividends during the year. Required consolidated statement of profit or loss for the year ended 31st March 2023, then consolidated statement of financial position. So we can kick off. So here we can do some small analysis. We have River Limited acquired 80% of SAI Limited and 40% of Tutu Limited, like that. So have that, please. So this means, just a minute. This means that in SAI, how will we consolidate in SAI? In SAI, River Limited will have 80%, while minority, non-controlling interest will have 20%. Like that. Tutu is an associate. Associates, we don't consolidate for them. We only take our investment and profit share. Take note of that. So have that analysis. Good. Check for me the duration. We don't have minority in associate. Actually, we are the minority. So check for me the accounting period. The accounting period is ending on 31st March 2023. So it means For our financial year to end on 31st March 2023, when should it start? I want to see from someone. It should start on 1st April 2022. Good people there. So that is correct. 1st April 2022. When did we acquire SAI? You know, I'm going to be very keen. Whenever you have been asked to prepare profit and loss account, you need to be keen with the period, because income and expenses must be time apportioned. So when did they acquire SAI? Check additional information number 1. SAI was acquired on 1st July 2022. 1st July 2022. That is when SAI was acquired. So here you can say SAI. That is when SAI was acquired. Then in note number 3, on 1st January 2023. So 1st January 2023, Associate was acquired. Tutu was acquired. So you need to tell me SAI is equal to how many months subsidiary. It was acquired in July. So you count from July to March next year. How many months are those? It was not a full year subsidiary, so you check the number of months. How many months are there? Nine months. Leo mumeamuka vizuri. That is very good. Those are 9 months. So this is 9 months subsidiary. 9 months subsidiary. Then Tutu was acquired in January. Hata mimi pia watanichangie. Sikuwe na wafinya kabisa. So Tutu was acquired on 1st January. The year is ending on 31st March. So Tutu is 3 months. 3 months associates. How that is? So how are we going to consolidate? Very important. How are we going to consolidate? So P&L, how are we going to do consolidated profit account? Consolidated profit account, you are going to add income and expenses of River in full. Remember, River is the parent, plus SAI, but SAI, you will account only for 9 months. Only for 9 months. Tutu is an associate. Associate, we don't have control. Control exists at 51. So we leave it out. Please take that into account. Even if it was a joint venture at 50 sharp, you don't consolidate for it. We only consolidate for subsidiaries. So Tutu will not be consolidated for. So when we go to P&L, you will take River, but SAI income and expenses will be time apportioned for 9 months. Then CSFP. CSFP stands for Consolidated Statement of Financial Position, the balance sheet. Balance sheet, you will bring River, you will bring SAI in full. Full. We don't apportion balance sheet regardless of the date when the subsidiary was acquired. Even if the subsidiary was acquired today in the morning, we'll say motor vehicle for 9 months. No. Balance sheet is never apportioned regardless of the date when the subsidiary was acquired. But profit and loss account, we apportion income and expenses only for the post-acquisition period. So this is very important for you, this one here. So whenever in the question, you see the examiner telling you to provide a profit and loss account, be very keen to check when the subsidiary was acquired. In case the subsidiary was acquired before this financial year, then you don't apportion, you just take them in full. We only apportion if it was acquired within the financial period under consideration. Correct. Aye. That is good. Now, I want us to do some small workings before we go to the presentation. Just a few. I just want us to check a few workings before we proceed. So I hope you are done with this. There are some few things I noted, which I want us to check. Working one, unrealized profits. Unrealized profits on inventory. There was some stock which was sold and they remained. So we have to calculate unrealized profit on them. All right, so UPI, you take the profit margin. So that one we are in note number 4. They reported 20% profit margin. So you take 20% times the value of goods which remain. They said a half. So a half of 300. Half of 300. How much is that? 30. Thank you, Oli. So unrealized profit is 30. I also want us to check unrealized. I saw it there. Unrealized profit on fixed assets. On fixed assets, popularly known as UPFA. Popularly known as UPFA. So UPFA, we are referring now to note number which one? I saw it in which note? 6. Note number 6. Profit of 25% margin. So you take the profit margin again, times the value of that asset. You know, asset, I was going to say what remained. Asset you multiply with everything. So you multiply with the value of that asset, which is 400. I believe that is 100. I believe so. I believe that is 100. Then these people were charging depreciation. They were charging depreciation at what rate? 20%. Yeah. The group, read the next paragraph in note 6. The group charges depreciation on plant at the rate of 20% per annum on cost on full year basis. On full year basis means we are not allowed to time apportion depreciation. So they are charging excess, what we are calling excess depreciation, because they are even depreciating this profit. Profit should not be depreciated. So excess depreciation will be 100 times 20%, which is 20. So they are charging excess depreciation by 20. That is wrong. So that is good. What else can I bring in the picture at this point? At this point, I could have brought the issue of goodwill computation, but for purposes of P&L, goodwill will only help me to get impairment, but they said there was no impairment. So to avoid wasting time, we can do profit account. Yeah, I can do profit account presentation. Then before we go to balance sheet, we can do goodwill, retained earnings, and NCI, those 3. So for now, let's do presentation of P&L. We don't have time to waste. So right there, River Group consolidated profits or loss for the year ended year ended 31st March 2023. So have that, we maintain one column. So have that, then we start together. All right, so we start with sales revenue. Please remember, for SAI 9 months, 2 out. 2 we only take profit. So revenue, so you flow with their P&L. So revenue you will take 4190. There's some reflection there. Yeah, you can use that one meantime. 4190 plus 26, but 26 for 9 months. 26 for 9 months minus intergroup sales. Whatever they have sold amongst themselves, sale of goods, that is the 300. There was the that sale in note number 4. The sale of goods of 300, you subtract. Whatever you sell between group members, there is no sale there. Hiyo unatoa. So this is intergroup sales. You remove in full plus the profit. Hakuna sale. Ukiuzia sister yako, your brother, your mom, your dad. That is not a sale. In fact, you can even say it's abbreviation. So you subtract. So give me this. To obey Bodmas, start with the multiplication. 26 times 9 over 12 plus this minus 300. Olivia is getting 58.40. Someone to confirm? 58.40. Good, that one has been confirmed. Cost of sales. Cost of sales. 2730 plus 1400, but 1400 9/12. I hope you will understand how I'm going to work the cost of sales. Yeah. Please, let's have cost of sales hapo nje. Sitaki kuwafinyilia sana. We are still in the first stages. So have cost of sales as a working hapo outside somewhere. Cost of sales, River is 2730. This side is 1400 times 9/12. What is 1400 times 9/12?
$10.50.
1050, thank you. 1050. Then, so add for me this. This one will be 3780. 3780. Then you less intergroup cost of sales. Intergroup cost of sales. You know, when these people sold, in their books it was a sale. The other side it was cost of sales. So you will take 300, but 300 was sales. So subtract the unrealized profit. Unrealized profit ilikuwa ngapi? 20 ama 30. There was one which was 20, another one was 30. Which was which?
30.
30. So you subtract 30, meaning the intergroup cost of sales was 270. So you subtract to 70. Then there was excess depreciation. Excess depreciation. They say depreciation was charged to cost of sales. But even if they don't say depreciation in a cost of sales. So you see they were charging in excess because of that profit. So you subtract the excess depreciation. I believe then it is the one which was 20. I tend to believe. Yeah, I tend to believe it is the one which was 20. Then there was the unrealized. The unrealized profits. Yeah, there was the element of the unrealized profits, which was how much? How much was the unrealized profits? How much was our unrealized profit on fixed assets? The unrealized profit on fixed assets was how much? Brian, it was 100. So the unrealized profit, we need to add it to the cost of sales. It is also an expense. The unrealized profit, that 100, we need to add it as part of expenses. So you add UPFA, which is 100. Wisha. Give me now the total. 3590. Thank you so much. 3590. Because we had working 1, working 2, let me call this one working 3. So instead of showing because we only economy maneno mingi, so let's say this is working 3. Cost of sales working 3, 3590. So gross profit is the difference. Can you give me that difference, please? Help me with that difference. Somebody? $22.50. $22.50. Thank you. We proceed. We proceed. Just check their arrangement. Just check the arrangement. Distribution cost. Distribution has no problem. 300 plus 200. 200 for 9 months. Give me that one. Ama wacha munipatie zote mbili. Admin 500 plus 400. 9/12. So help me with the 2 answers. Help me with the 2 answers.
Distribution cost is 450.
Yes. No,
distribution cost.
Niandikie kuna echoes. Thank you. For 5,800. So operating profit inafuata tu ile yao zenye iko. Operating profit will be how much? $1,000. Okay. Operating profit inakuwa exact 1,000. Thank you. Proceed. Wewe shikilia tu hiyo yao. Investment income. Investment income 40 plus 20 times 9/12. That is 1555. I believe so. If it is 55 is okay. Then associate wanaingia hapa sasa. Associate, we have not been considering associate anywhere. So you only take their profit after tax. Unaweka hapa. So share of associates, PAT, profit after tax. Associate profit after tax. The parent will take 40%. 40% times, check the profit after tax of associates. Profit after tax for the year, associate is 200, the tutu. But tutu was only 3 months old. Can you check that and tell me how much? That one I'm told. Finance cost tunaenda hapo side down. We are proceeding there immediately after this. I was just bringing it with the investment income then. Yeah. So that is 20. Then finance cost. 80 plus 60. But 60 for 9/12. How much? How much? Honorable members? 125. Thank you. So what you get is profit before tax. Profit before tax. How much? $900. Huh? 950 ama 1200, which is which? I'm seeing contradicting figures. 1010. The way I know you people, 1000 plus 55 plus 20 minus 125, we cannot have three different answers. What is not happening? We can't have three different answers for something small like that one. Another one, 1050. So which is which? Which is which? Who is now clearing it well? Olive, 950 again. 950 is being confirmed. Surely. Brian P. and 1010. Hey, 1000 plus 55 plus 20, that is 1075. 1075 minus 125 is equal to 10. That one hata kama sina kala. It is 1075 minus 100 peke yake ni 9 something huko. 950 should be logical. So 950. Yeah, that is. Some people are adding finance cost. So that is 950. Then you bring income tax. Income tax, you earn 180 plus 160. 160 for 9 months. For 9 months, what do you get? How much after that? You get 300. Therefore, profit after tax, PAT. What do you get as your PAT? Profit after tax 950. That is 600 and 650. It is 650. Correct. Share that profit. So profit, the consolidated profit, you share between two. So share PAT to minority, NCI, and holding company. Holding company is the parent. So you share to them that profit of 650. You share to them that profit. You share to them that profit. So NCI minority cannot share the total consolidated profit. They only take the profit of the subsidiary. So NCI have a working outside there, working for NCI's profits profit share. So they take PAT of the subsidiary. That is what they are entitled to. Alright, so PAT of the subsidiary is 400. 400 times 9 over 12. 400 times 9 over 12, that is 300. I believe so. I believe so. Then subsidiary was charging excess depreciation by 20. I hope you can remember. Subsidiary was charging excess depreciation by 20. You know, when you charge excess depreciation, you are understating profit. So the profit was understated because of the excess depreciation. So you add back. So that is 300 and what? 20. Therefore, NCI will take 20% of 320. How much? 20% of 320? Done? 400 times 9 over 12 times 20 over 100. 20 over 100 ni gani? The one for 20 over 100, I don't understand. Done? The 20 over 100 is coming from what? So that is 64. So minority in this group only takes the profit of the subsidiary, the profit after tax, which is 400 times 9 over 12, which is 300. Then you add back excess depreciation. We had calculated this one somewhere to be 20. So the adjusted profit of the subsidiary is 320. Then the parent was entitled to 80, they take 20%. Therefore, for the consolidated profit of 650, minority will take 64. So parent will take 650 minus 64. How much goes to the parent? 650 minus that 64. How much goes to your able parent? 5 something? 5 something? $586. Thank you. So NCI, this is working for. It was 8 marks. Ama ilikuwa marks ngapi? Yeah, it was 8. We needed 4 ticks. Any 4? Any 4 at 2. Any 4 times 2, 8. So I know what was difficult here, 2 things for student, 2 things. One, knowing that 2 should be out. That was one, very critical. Ukiongeza 2 may mess the entire question. So 2 out because it's an associate. Even joint venture will let you have 50%. After knowing that, if you pay to apportion 9 months, so it was 2 out, then profit, income and expenses of the subsidiary, you take 9999. So whoever does that will get some free ticks. Free ticks is on the finance cost, right? Investment income has no problem. Administrative has no problem. Distribution, there was no problem. Even income tax, there was no problem. So any student who saw those 2 elements will sail through that question. The two elements is knowing that associate is out, that is one. Then two, seeing the months correctly for the subsidiary, then you pass it without problems. I want us to go to the statement of financial position. So allow me to delete this. So working five, let's have here working five. Working five, let me have it on investment in associates. You know, associate is a small company, but your investment, lazima you keep on adjusting. So let's have investment in associates. So associates, we only take the investment for balance sheet purposes. For balance sheet purposes, it only appears there once. So check note number 3. Check note 3. On 1st January, River Limited acquired 40% shareholdings in Tutu Limited for cash consideration of 500 million. So that is what they invested initially. So initial investment, they invested 500. Any profit that company will make after acquisition, you keep on increasing your investment. So you add post-acquisition profits. You add post-acquisition profits. So post-acquisition profits will be 40% times 40% times, because parent was only entitled to 40. So 40% times the profit the associate made. So check P&L. P&L, how much is the profit of Tutu in the profit account? How much are you seeing? How much profit are you seeing? Somebody? Olive, 200, correct. 200 is okay. That is the profit for the year. So for the whole year, they made 200, but Tutu was only here for 3 months. So you take 3/12. So 40% of 200 for 3 months. How much is that? That is 20. Thank you. So our investment in associates is 520. Have that. Itakuwa non-current asset. It goes to non-current assets. I also want us to calculate goodwill. Goodwill. So goodwill, we are only calculating on acquisition of SAI. So goodwill on acquisition, SAI. SAI Limited. SAI Limited. Before I start goodwill computation, kuna kitu najua kitanisumbua mahali. So I don't want to waste time. Leave like 1, 2, 3, 4, 5, 6, 7. Leave 7 lines. Leave 7 lines. Then you say retained earnings. Unaona when itatusaidia on acquisition side. When SAI was acquired, how much was their profit? It's going to help us somewhere. They are very critical. So remember, SAI was acquired in between. Sai was acquired somewhere here. Goodwill is computed on the date of acquisition. So I've just checked the question and I've realized the examiner did not give us the profit on acquisition. I know profit on acquisition is going to be part of net assets. So study kusimama tukianza, so I want us to finish on it. So to get the profit when you have been denied, check profit for the year for Sai. Check the P&L. Their profit for the whole year, you know the whole year is from here to here. They made a profit of 400 for the whole year. For the whole year, 400. Higher. That is for the whole year. Then remember from here to here was 9 months. This was 3. So it means from here to here, you take 9 over 12. 9 over 12 times 400. Hiyo tumekuwa tukifanya tunapata 300. So it means in the post acquisition, from here to here, they made 300. But the closing profit in the balance sheet, check balance sheet, retained earnings of Sai in the balance sheet. Check and tell me how much you are seeing. Check and tell me how much you are seeing. Check and tell me how much you are seeing. Check and tell me how much you are seeing. 800. Yes, it is 8. Only not 5. We umeenda kwa 2. Sai, their profit at the end of the year is 800. Ama ushafanya. So here, on the date of acquisition, their profit was 500. You take 8 minus backwards the 3. Because from here to here, they made 3, but total is 8. It means on this date, their profit was 500. There. That was their profit on the date of acquisition. So just have that profit silent somewhere. It will help us. All right, so let's start. Goodwill. Goodwill, you take purchase consideration. Purchase consideration. Purchase consideration. Purchase consideration, read note number 1. Additional information number 1, 1100. Then they said in note number 2, the group policy is to measure the non-controlling interest as their proportionate share of net assets of the subsidiary. So fair value of NCI. They have said proportionate share of net assets. Net assets is ordinary share premium, retained earnings, revaluation, if any. So you will take 20%. Proportionate means you use their percentage. So can you check for me ordinary share capital of the subsidiary in the under equity? So when you check equity, ordinary, you will see 500 plus share premium, you will see 200 plus retained earnings was 500 on the date of acquisition. That is why I really wanted it. So retained earnings 500. For your revision, you can indicate in your books, ordinary, share premium, retained earnings. All should be on the date of acquisition. There was no revaluation. The examiner says somewhere there was no revaluation. I could have factored for it. So give me 20% of that value. Tell me what you are getting. Napata ngapi? People are getting 240. Thank you. So this is 240. So that is 1340. Then you less you less net assets acquired. You less net assets acquired. So net assets, ordinary. Ordinary share capital, this one, 500. Share premium, this one here again, 200. Retained earnings on the date of acquisition, 500. So this is 1200. You subtract. So it means goodwill is 140. Who has a question as to the goodwill computation? Who has a question on goodwill computation? Who has a question? It seems no one has a question. And I want us to just finish those workings so that we just do presentation. So we are remaining with 2 workings or 3 maximum, but 2 major, the retained earnings and non-controlling interest. So allow me to start with retained earnings. So working number 7, consolidated retained earnings. How they are consolidated retained earnings. Those are ndio tutatushika hapo mbele. Consolidated retained earnings. You check for River. Remember, we are preparing balance sheet. So go for the retained earnings in the balance sheet. So retained earnings of River Limited is in the balance sheet. I'm seeing 10, 20. I'm seeing 10, 20. 10, 20. You add post-acquisition profits. For the subsidiary and the associate, you only bring post. Post means the profit they got after you acquired them. Only what they got after you acquired them. So post-acquisition, let's bring SAI, what SAI made. I will take 80%. 80%. SAI made, after acquiring SAI, check P&L please. Check P&L. Check P&L. P&L, SAI made 400, but post-acquisition is only 9 months. Wait first. 400 minus, there was what? There was excess depreciation. So actually that excess, we should add it back, not subtract. So add back excess depreciation. Excess depreciation was 20, I believe. Yes, it was 20, the excess, times 9/12. Please indicate in your books. Yeah, indicate in your books. The 20 is excess depreciation. You need to add it back to their profits. That one will be how much? 80% of 400 plus 20, but 9. No, this 20 should not be subjected to 9/12. I think it will mess up. Let me just separate them to make our work easy. Do this plus 400 times 9/12 first. Let's just go procedurally to avoid maneno. So 80% of that will be how much? Yeah, let's do it separate. Done. 80% of that bracket will be how much? How much will it be? Brian? 240. This is 240. Then we add back, add excess. Excess depreciation was 20. So 20 is what I will take 80%. 20 we are not supposed to multiply by 9/12. We are already. So 20 to the measure multiply. Was 20 already, you know, I can't recall very well, but I think it had already been multiplied. So how much is that? 20% of 80% of 20 should be 16. Is that 16? Yes. So you add back 16 because it was understating this profit. All right, let's bring 22. Parent will take 40% of their post-acquisition profits. So post-acquisition, just check their profit, which is 200, but for 3 months. 200, 3 months, 40%. How much is that? How much? Olive, 20. All right. There was unrealized profit. So less UPI, less UPFA. UPI and UPFA is only affecting parents, so you subtract them in full. UPI was how much? How much? Give me the two answers. This one, comma, this one. How much? The UPI and the UPFA. 30. UPFA ilikuwa mingi, ilikuwa 20. This is 30. I think it was it was 100. You sure? This one was 100. Yeah. So I don't see anything else. That should be your consolidated return profit. Can you give me the time? But if there are so many things we are going to get there without this working. But you see in class now we have to balance. So lazima nifanye kila kitu. Done. 1166. NCI. Let's check NCI. Let's calculate NCI's equity. Let's be specific. NCI's equity. The equity of the minority shareholders. All right, so we start. What was their fair value on acquisition? Fair value on acquisition, where we calculated goodwill. I think goodwill was working number 6, if I'm not wrong. How much was fair value of NCI on that date? Working 6. Check for me, working 6. We already got it somewhere. So how much is that? Okay, Brian, this answers me mingi, which is which. Brian says 240. I think that is true because it was 1200 times 20%. Yeah, 20% of the 1200. We got 240. Then you add to them the post-acquisition profits. This one here. You see, so I took 80 of this. Minority will take 20 of this. Excess depreciation. Parent has taken 80. Minority will take 20. So post-acquisition profits, give them 20% of 400 for 9 months. Add back excess depreciation, excess depreciation, you will give them 20% of 20. 20% of 20 is 4. 300, 20% of 300 is 60. Please confirm 300, 3 or 4. Confirm if I'm accurate. Please don't put, you don't put the America often. If I'm accurate, you just say okay. Dan has confirmed. I think there is no working we should do. Those ones are enough. Those ones are enough. So we can start consolidation. Unless someone has a question. Unless someone has a question. Unless someone has a question. There is no question. So right there, River Group. Consolidated statement of financial position as at 31st March 2023. One column, shillings in millions. Good. So we stick to their balance sheet. So non-current assets. So for purposes of time, I request that you give me the answers promptly as you have them. Property, plant and equipment, PPE. PPE. So PPE, you will take, so balance sheet, there is no apportionment. So you will take 2070 plus 1290 minus, remember, there was unrealized profit on fixed assets, the 100. So you have to subtract. You have to subtract. So in case in your books, UPFA, this is the unrealized profit on fixed assets. Then you add back excess depreciation. Why do we add? Because excess depreciation is understating our assets. So you add back the 20. So 20 is the excess depreciation. So you subtract the unrealized profit, then you add back the excess depreciation. Give me the answer. Olive, 3280. So that is 3280. Investments. Whenever your investment, you don't bring it here. Those are investment, you check. If all of it was internal, then you don't bring that investment here. Number one, we invested in subsidiary, check note 1. We invested 1100. In associate note 3, we invested 500. 500 plus 11, you know, the year 16. So the 16 was intercompany investment. We don't bring in consolidation. So what we invested in subsidiary, you replace with goodwill. So goodwill, check working 6. How much? How much was our goodwill? We got it somewhere there in working 6. How much was it? 140, Brian. Goodwill was 140. Then investment in associates. Investment in associates. That was working 5. Check working 5. We adjusted and we got how much? Investment in associates. In working 5. We got 520. Then there is nothing. Can you add for me non-current assets? Add for me the non-current assets. Non-current assets, somebody is saying 3940. Current assets, we have inventory. Inventory, we have 530 plus 390 minus unrealized profit. Unrealized profit was 30. Sure? Was it 30? UPI, working one. Yes, 30. Working one. You did not down there, W1. So 530 plus 390 minus unrealized profit on inventory. What do you get? Actually, this 100 was working two. This was W2. You get 890. Only you get 890. Trade receivables, just write receivables. Receivables, there is, kuna venye wajaandika vizuri hapo, 640 plus 470 minus, there was intergroup debts and also there was cash in transit. Cash in transit unatoa kwa receivable because you no longer expect to receive, it has already been paid. So if you check note number 5, included in trade receivables of River was 80 due from S. In the books of S Limited, the amount due to River was shown as 60 because they had already remitted 20. So minus 20, which is cash in transit. When someone has paid, you reduce debtors, the receivable, minus intergroup debts. Intergroup debts must be eliminated from receivable and payables. So payables, they have already paid 20. Ni hawa hawajatoa huku juu. So huko chini utatoa only 60, not 20. 20 has already been paid, so it is no longer payable. So you take 640 plus this. This is CIT, cash in transit. Then 60 is the intergroup debts. How much? 1030. 1030. Then we have financial assets. So financial assets, hapo haina shida. You just add 300 plus 150. That is 450. That is 450. Cash and bank balances. So cash and bank, you will have 360 plus 200 plus, I want you to tell me the plus, the other plus. Plus what? What are we adding hapo mbele? I want to see in terms of the figure or wording, whichever. Brian plus 20, correct. The 20 is this one here, cash in transit. So cash in transit, the CIT, you add it to the cash, you subtract receivables, correct. So plus 20, 380, 580. Therefore, total assets, so you add from non-current, from 3940. Can you add everything? 10 minutes, tunamaliza hiyo. Somebody will be getting? Someone should be getting how much? Brian, 6890. Thank you. Equity and liabilities. So, Oli, there is no need for you. There's no need of adding current. You'll just be wasting time. Hata unaona total they don't mark. Hapa tunaweka tu ndio tujiconfirm. So kwa mtihani hata usimwart totals haina shida. They just mark these two entries. So don't waste time adding current. That one enough that time is enough to write something. So if you want to add the total, fine. If you don't want, example. Equity and liabilities, ordinary share capital. How much? I want to see from somebody. Ordinary share capital. How much in terms of the figure? Ordinary share capital, how much? Maria, 2,500. Correct. Parent only. You are really boosting my morale. Parent only, because naona watu wanaelewa. Wenye walikuwa wamesahau wamekumbuka. In group accounting, nili explain ile siku na nilisema sitairudia ku explain. Where you are to hivi. Ordinary share premium, parent only. Unless parent has issued some shares, we'll take what we have been given plus the ones they have issued. Here there was no issue, so you take parent only, 25. Share premium, the same, parent only. Share premium, 500. Retained earnings, working number 7. Check working 7, 1166. That is what we got. Minority, non-controlling interest, working 8, 304. Those are the only equity family. Can you add and tell me the answer? Add and tell me the answer there. People are getting 44, 70, right? 44, 70. If that is confirmed, we go to non-current liabilities. Yes, Oliver's confirmed. So non-current liabilities. Non-current, we have 12% loan notes. 12% loan notes. 640 plus 640 plus 480. That is 120, 1120, confirm. 1120. 1120. Then we have deferred tax. Deferred tax to 60 plus 100. That is 360. Current liabilities, payables. Payables for 20 plus 330 minus intercompany. Intercompany was 60. Usilete cash in transit hapo. How much is that? $690, Brian, and Olive, 690. Then we have current tax. 160 plus 90. That one I know. 250. Therefore, total equity and liabilities. Can you add from equity the 4470? So I'll repeat that. 4470 plus the rest. Then I repeat for that. Can you add the total there? Only balance. So balance means 6890. I hope that is it. 6890. So then I repeat on payables. Payables, you just add the two, then you subtract intergroup debts. When you check that note, they said the debt was 80, but those people had paid. You know, payables, they have already paid 20, the cash which was in transit. So it means the correct balance is 60. So the intergroup balance, you subtract it from receivables. Also, you subtract it from payables. So you don't bring the 20. 20 they have already paid. From payable side, it has been paid. Problem is with the receivables. So receivables should subtract it, then add it to cash. That I hope umelewa. Unless there is something beyond that. Done? Yes, okay. So in this question, students were expected here, they were expected to get 6 ticks. Only 6 to get 12 marks. So the 6 was to come from here. 1, 2, 3, 4, 5, 6. Without struggling, I'm marking without struggling. 6, 7, 7. So without the student even thinking, ulikuwa unapata hiyo swali yote without thinking. But of course, hilo unapata. I've taught you, you need to get inventory, unafaa mpate, receivable you should be getting, cash you should be able to get as well. But now, the only thing is the student knowing that 40% is not supposed to be included. That is the associate. So if it is 50% sharp and below, you don't include them during consolidation. Any student who knows that atapita hiyo swali without problems. Problem comes when now you are adding the 3. You will utapata 2 answers when you wewe ndio unataka. So our next, and so far, let me hear from you. Alex, umekuwa very quiet. Brian, Dan, Francisca, hata wewe umekuwa quiet. Joshua, Linda, Maria, Olive. What is the, so far, if we can gauge, is the group that very difficult? You know what wanasemanga group ni mbaya sana. So far, it is something you can say ukienda kwa mtihani, assuming we were to stop at this question, of course we are going to another one in our next class. It is something ukipata kwa mtihani unasema no. This question is not meant for us. What do you think? It is that dangerous? I change strategy in the next question. Yes, that it needs more practice. That is true. Not only this, all topics needs more practice, and even all the units needs more practice. Someone else? Olive, Maria, what do you say, Joshua? Francisca, Linda, mnasema nini? Alex, Francisca, Brian, what do you have to say? How is group so far? If you can rate it up. Ni swali inaweza walemea sana, ama it is something we can always give an attempt in exam so far. I'm just checking there is a type of a question I want. It is that difficult. Naona watu wamekimya. Joshua unasemaje? It has not yet sunk very well. it will sing. Maria, the workings, but can try. Either workings, mbona ni ngumu hapo itakushtua sana. But now you see we still have time for you to give it thorough revision. So please know your weakness mapema. I think it's not. So I just mentioned there is something I wanted, but I'm not getting it. So I just get it mentioned during computation. So I'll go back to this one was April 2023. I'll just go back to December 2021. So yeah, we'll check on that. December 2021, question 3. Question 3A. December 2021, Olive. Some people talked here. Olive said not much. Brian, tricky, but practice is manageable. Of course, P&L account should have more marks than balance sheet. Inakuwa na mingi actually than balance sheet. Lakini sasa examiner akishaongea, who are we? So now, you know, I wanted you to say that, you know, mtu anajua topic, at least ukisema mali ngumu, it means you know that topic. Because you cannot say anything if you don't know even the topic itself. So by you pinpointing some things means you know what it is. So we are better off. So our last question, that is tomorrow in the evening. And tomorrow is my birthday. So the ministry come in India because I will not even celebrate the birthday because of you people. So this is which setting is this? December 2022. Question number 3A. Page number 15. Yes. Done a birthday in advance. So let's meet there tomorrow. We finish up with that question. Bora tu unajua venye group inafanywa haina maneno mingi. Provided you know the structure. Huwezi anguka. So we do that one, then we scale ahead. There are some topics. We can even do it for the whole year, but there are some topics to be covered. At least that one, you know what is happening. Thank you. Do have a nice day. I'll share the recording later.